If you say you're a value investor, you're using one word too many.
Right.
You're an investor. Growth is just attached to the hip of value.
It's a component of what you're prepared to pay.
Yeah, so we're investors, but all we're trying to do is check that the cash is there, how much cash, and compare that cash to what we're being asked to pay today. So the definition of investing is laying out money today to receive more money tomorrow. It's as simple as that.
Brought to you by Progressive Equity.
In this episode, I'm joined by someone who I reckon is the best performing smaller companies fund manager you've never heard of. I first met Geoff Oldfield in the 1990s when he was working as the co-manager of the Barings Asset Management European Select Fund. He and his partner, Gerhard Schoening, were making a name for themselves in the sector. And in 1998, they left to set up Ennismore Fund Management with some very firm ideas about the type of investment firm they wanted to run. The main pillars were performance over asset gathering, investment decisions taken by PMs, not a committee, clawback of performance fees to reward individual contribution, and a firm owned internally by its portfolio managers. Ennismore's first fund was launched in January 1999. It has been closed to new investors for most of its life, and a significant proportion of the fund is owned by its portfolio managers, including Geoff. I was fortunate enough to invest in the Ennismore Smaller Companies Fund on its launch. Over the subsequent nearly 25 years, it has delivered a 17-fold increase in value with a focused absolute return strategy in European-listed smaller companies. This is an average annual return of some 12%. And remarkably, over the period, the fund has only had 3 down years, 2008, 2009 and 2020, which together represented an aggregate negative 12% return, a track record fully demonstrating the advantages of an absolute return approach. Geoff is not a public figure, and I have spoken to him about doing this podcast since he returned to frontline fund management a few years ago. After a 10-year break, Geoff came back into portfolio management in an effort to help turn around the Ennismore Global Fund. This 2016 fund had scored an own goal, as Geoff puts it, while running short positions in the meme stock-obsessed Nasdaq market of 2020. Geoff is the epitome of the humble investor, being respectful of Mr. Market and also knowing when to take advantage of his emotionally charged moments of misvaluation. He talks about mistakes he made in the GFC and how providing liquidity to investors is a good discipline, despite the fact they invest in an illiquid asset class. He also describes how he defines quality companies and how they should be valued, but he also talks about how he always looks for a margin of safety and what he understands as risk. Critically, he discusses what makes smaller companies such a rich seam of opportunity for value investors, a strategy he has successfully pursued in a changing market for more than a quarter of a century. I must remind you that nothing you hear today is investment advice. The views expressed are personal to the contributors and do not represent the views of Progressive Equity or Ennismore Fund Management. I hope you find it enjoyable and educational. As always, when I chat with Geoff, I learned a lot. Please enjoy my conversation with the maverick investor, Geoff Oldfield. Geoff, thanks for joining us today. Can we just start with you just telling us a little about how you got started in investing and what attracted you to investing in the stock market?
I knew very little about the city, about investing, so I came to investing very late. I didn't know exactly what I wanted to do. I was actually trained as a credit analyst. So for many years, I thought it was a lot better to be a debt provider than an equity provider. I also didn't even know what an equity provider was. And I liked the security of being able to get my money back. One of my first jobs was to work in receiverships for Midland Bank, as it then was, taken out by HSBC. That was in 1984. That was a very instrumental experience in seeing what can go wrong with businesses and how you get your money back. That must really spike my interest in looking outside of the world and looking at businesses. And I was actually in an internal audit role within the merchant bank, Samuel Montague. And we audited many different parts of the group, including going off to Japan, to Australia, to various businesses. And one business that really stuck out for me as being very interesting was the old Greenwell's private client stockbroking business. And when I audited them, suddenly it was like a light bulb moment going on for me that I just found it fascinating that they were analysing real companies, meeting the senior management and trying to assess whether they were good investments or not. I suppose, I wangled my way to the investment side at Midland Montague Asset Management. I did that first by applying for, many different jobs, but the one I got was a marketing and sales job at Midland Montagues. This would now be 1987. My job was to sell the star portfolio managers at Midland Montagues. I did quite quickly realise that maybe they weren't such stars.
So you got a good overview of the sell side and the buy side?
Yes. And also I was doing a lot of cold calling and a lot of hand-holding with clients. Brilliant experience. I knew I wanted to try to get actually onto the investment side. But
you wanted to be an investor?
Yeah, but back then it was very much, did you know the right people? Did you have the right background, et cetera, et cetera? And I definitely didn't have the right academic background. I had a 2-2 from Loughborough, so there wasn't an easy way in, let's put it that way. I pitched to set up a green fund.
Wow.
This was 1987, which they very nearly did. And in my proposal, I was going to be the portfolio manager to run it. Long story short, one of the guys on the European team left. So I joined the European team. And they actually gave me a little tiny fund to run pretty much straight away, actually. That was how I got started. And that was a European small cap fund. So it was just chance that I got involved on the European small cap side.
Tell us about how you went from there to joining up with Gerhard and then starting Ennismore, which from memory was around 1997, 1998.
I've always had this approach that if you're not settled in a job, then don't just put up with it. Keep moving, basically, till you find things that are right for you.
Which was quite revolutionary in his day. In those days, the advice was get a nice steady job with a superannuated pension plan and stay there for the rest of your life.
Exactly. So I can still remember my dad taking me down to meet the local bank manager in Birkenhead. And if you get a job in a bank, it'll set you up for life, mate. It was just on that chain where people were expected to have a job for life. Anyway, so I joined Gartmore, name from the past, that was an incredibly successful fund management business. That was in 1992. And although I was given quite a large fund to run, the European fund, I did not like at all the sort of the macro angle that you had to do of always assessing, what the Bundesbank were about to do and the asset allocation between different countries. I just found it an enormous time distraction from doing what I wanted to do, which was just look out into the outside world and find good companies. So despite the fact that, my prospects were pretty good there because it was an amazing cash machine, I left to join Enschilder in Frankfurt, and that's where I first worked with Gerhard. So that was a move from the buy side to the sell side. So in Enschilder in Frankfurt, we were researching and broking German small cap stocks back to the UK. But the way that came about was, again, these things are often luck. I was rushing out the door, the phone went, and I thought, oh, God, yeah. So I picked it up, there was no one else around. And it was Gerhard calling from Enschilder in Frankfurt. And that was the first time I'd ever spoken to him. So I was still at Gartmore. And I could just tell straight away he was someone who was incredibly passionate about analysing businesses. And he'd come across Camper House, which was a modular house builder in Germany. And he could hardly contain himself for telling me all about Camper House. So for various reasons, I quite like the idea of living abroad, improving my language skills. My wife's German. Long story short, I decided to go and join Geoff. And we worked then for Enschilder for about 3 years. I joined Baring Asset Management at the start of 95 with Geoff. And again, luck is so incredibly important with these things. And the fact that Baring was incredibly unlucky because towards the end of January 1995, about 2 or 3 weeks after we joined, Baring went bankrupt.
Thanks to Nick Leeson.
Nick Leeson in Singapore, who was killing the senior management, all the money he was making. So the senior management kept on sending him more and more money. From Gerhard and my point of view, it really was an amazing stroke of luck, because we were about to be given a large commingled fund where we would just be running internal money and no one would have heard of us. With Barings going bankrupt, they had a number of outflows. So they thought, oh, what are we going to do with these two reasonably senior guys who had recruited the head of European Small Cap? And fortunately, they had a little unit trust hidden away, the Europe Select Trust, which was £20 million. And they said, oh, well, what can you do with this? And so we threw ourselves into it and had 3 great years of performing well, very well. That gave us the platform to leave and set up Ennismore. Not that we've been intending to leave instead of on our own, but it was circumstances that led us to do that.
But I think that fund that you ran for 3 years was one of, if not the top performing fund, one of the top performing European small cap funds in that period. So you pretty well knocked the lights out in that period at Barings.
An obvious question is, why do we leave and set up Ennismore? And I guess it was very much one of those classic sort of institutional type situations where we'd had a good track record, but at the very time that we should be batting down the hatches and focusing even more on performance, the sales force wanted to take us out and on all sorts of road shows to raise more and more money. And, we saw that is the last thing that we needed in terms of being able to perform well. So that was one sort of bugbear that we had, if you like. And the second was institutions that we'd been promised, a certain amount. If we achieved a certain amount, we'd achieved that and quite a lot more. But surprise, surprise, they turned around and said, oh, really sorry, guys, we've had a bad year overall, so we can't pay you what we promised you. It was a real break of trust. And so Gerhard, who, well, you know very well, Jez, he was a very strong character. He literally sort of grabbed me by my arm. Go on, Geoff, we're off. So we just walked out the building and went for coffee, as we often did. And then he'd get a little note out and we tried to figure out how could we set up a business that would never, ever have to do that to its employees, to break a promise. And we came up then with the principle of clawback.
The principle that performance comes ahead of asset gathering.
That was that start of everything. It's the idea of never, ever having a sales or marketing person.
So that's the reason why most people have never heard of Ennismore Fund Management.
I guess so. We're all about trying to perform well and not to gather assets. The clawback one was very interesting and I think has stood us in great stead over our first 25 years. It simply means, let's say you've got a fund with performance fee structure, one portfolio manager. So we have a multi-manager system, so we believe investments are best done by individuals. We don't want any one person running the whole fund. So typically we'd have about between 3 and 5 portfolio managers running a fund. Let's say it's just 2 PMs and you're starting off 1 PM is up 20%, they're running for the money 50-50. The other PM is down 20%. There's no performance for the clients, so there's no performance fee. But the PM that's up 20%, quite rightly in my opinion, is expecting to be paid well for doing that. The way we've been able to do that over the years, because everyone does have bad years, is that we then would claw the money back. We do claw the money back from the portfolio manager who's lost money and put that into the pot, which enables us to pay the portfolio manager who's made money. The great thing about it is that, of course, portfolio managers being portfolio managers, they all think that they're the best. And they look over their shoulders and they'll think, oh, this other chap's not quite so good. So I can see that with this clawback system, this is going to work really well because I always get paid. And that's been our history. That's been the case, that we've never, ever had to disappoint someone on pay. So the remuneration system is very transparent, very meritocratic. People manage a discrete portfolio and they both can have a share of the management fee, but also, more importantly, they get to earn a set percentage of the performance fee, where they can earn up to 85% of the performance fee if they generate a very good return on capital.
So in the early days, it was you and Gerhard, but you've grown the business and been able to attract, using this model, some high-performing fund managers and managed to retain them over the long period that you've been operating.
I think that's probably very much down to culture. For example, one of the main guys on the European fund, Tom Hearn, he was also at Barings, actually. He joined us 2003. I think the big attraction of Ennismore is the fact that we genuinely think long-term. The company is owned completely internally. in terms of our percentage of our funds under management, a reasonably high percentage is internal money. So people know the money's there. They know the way of thinking, which is to invest for the long term. And perhaps most importantly of all, it's the commonality of wanting to invest with a margin of safety. You also have an enormous amount of freedom within that, which, if you think about all these pod shops these days, I think it's most probably the exact opposite. You've always got someone looking over your shoulder. You're focused on short-term performance. So we really are the exact opposite of that, and very risk averse in that we've never used any gearing. Our longs have never gone over 100%. The approach, it either appeals to a certain type of person or it doesn't. And so, the guys that have been with us for the long term, it clearly appeals to them. Plus, obviously, also from an economic point of view, if they do well, they can earn very well.
Just talk a little bit, if you could, about the fact that you're an absolute return fund and how you've been able to use that to manage risk and control risk, because I don't think it's as obvious as it might sound. For example, you don't do pair trades, you don't operate in the sort of traditional macro-driven hedge fund style of trying to deliberately balance risk at the point of investment.
That's exactly right. We believe very strongly that each individual position, be it a long, a purchase or a short, should stand on its own merits. We don't like to do baskets or indice trades, just individual names. And so in many ways, we're looking for the exact opposite of what you're looking for in a long position. You want to be with a company that has a very weak competitive position, that is on the short side, that is overexposed to one or two customers who have a very strong negotiating position, who are overexposed to one or two suppliers, easy chance of new companies coming into the market, low barriers to entry. So it's sort of the opposite, really. But the big difference with the shorts is they can hurt a lot if you get them wrong, because obviously they're getting a bigger and bigger percentage. So the way we deal with that, to take into account what we call the degree of uncontrollable risk, the risk that someone silly out there, in our opinion, silly, who will pay a lot of money for a company, is by making the typical weighting a lot smaller than the typical weighting of a long. But absolutely key to us is that each PM, portfolio manager, we've got 7 portfolio managers now across the 2 strategies, the European strategy and the global strategy. Everyone genuinely enjoys the shorting side. That very much is the case. So everyone is charged with generating absolute return in each calendar year. So we don't want anyone to have an excuse at the year end to say, if I'd been allowed to do so and so and so and so, I would have performed so much better. So to give the individual freedom to PMs is very important. And to protect returns, of course, first and foremost, it's about just getting brilliant longs in there that are massively mispriced. But of course, if there is a really big stock market correction, then it can be very useful to have a decent short portfolio as well. So we short first and foremost to make money, but clearly the secondary benefit is that they do provide a hedge if markets do correct strongly. If I look at our track record on the long and the short side, it's on average since inception are the long-short spread. So the difference between if we gross up our longs to 100 and gross up our shorts to 100, on average we've added value of 20% a year between the two.
And that's over a 24-year period.
Yeah.
Having followed you as an investor over that period, the moments of crisis, the obvious one being 2008-9 for the original small cap fund, the shorting experience was very valuable, but also provided some learnings, I think, along the way in terms of your risk control process and just highlighting the things that can go wrong when you have a very fast and volatile market period.
Yeah, exactly. So we set up, January 1999. We hard closed in 2000. So we hard closed a year after launch at about 100 million sterling under management. We had good years, and the first negative year we had was 2008, when we were down just shy of 6%, 5.7% in sterling. But then also in 2009, we didn't bounce back as the market bounced back. So those 2 years were tough. And I would say in our history, we've scored 2 own goals. The first being, as you rightly say, that sort of period. And the second being 2020, I'm sure we'll go on to. But 2008, 2009. So we had both the UCITS, European Small Cap, and also the hedge fund, European Small Cap. And just any listeners, just to clarify, we set both those funds up day one. So they run exactly the same way with the same fee scale, same stocks. So they've basically got the same track record. We knew if we only set up the hedge fund back in 1998, the vast majority of the clients that knew us would not be able to invest with us. So that's why we set up the UCITS fund. So we run it as one portfolio. And the reason I mention that now is that when the world was really in crisis in 2008, what happened was a lot of our clients had got themselves into locked up situations with other funds where they'd tied their money up. We offered, that UCITS fund offers daily dealing and the hedge fund offers monthly dealing. I become more and more convinced over the years the importance of offering very liquid terms to clients. I think it creates a really good discipline all around. So liquidity management is very much in our DNA. What we saw there, so this didn't work to our favour then, in that it was particularly in the hedge fund, not in the UCITS, where we saw sizable redemptions. So that to me said quite a bit about the quality of our client base in the UCITS fund. But anyway, a lot of the clients in the hedge fund had really got themselves maybe into sticky situations elsewhere. So they used us as a cash machine. And that meant that coming into 2009, we weren't able to invest with the confidence that we would have liked. Let's say we'd had a closed-ended fund. Because to be quite honest, March 2009, the valuations were amazingly attractive. But, we were shaken by the redemptions. And so the hedge fund today is still very small. And I think in terms of our client base, and it's quite important to stress that the European fund's about 360 million, the two European funds there. Of that, of the external clients, more than 2/3 of them have been with us for more than 20 years. So I think the quality of that client base, it's pretty strong. So if we get another situation where we get a big market correction and we see just incredibly ridiculously cheap valuations, I think we'll be very confident in being able to exploit it the next time around. The mistake we made, you could say, well, I would say, would be we gave an individual PM his own fund to run. And I think that success went to his head. We replicated that portfolio within the main European fund, and that portion performed very badly. So the lesson I learned was don't give people individual funds. Keep it as one fund with the individual PMs managing money within that fund.
With individual sleeves.
Yeah.
Coming back to just sort of investment principles, how do you define a quality company?
I think there's only one answer to that, and that is a high-quality company is one that can generate a high and sustainable return on its capital employed. If you look at the profit and loss account, you want a sort of decent operating margin. You look at the balance sheet, you want a relatively small balance sheet in terms of the operating assets they use to generate the profit. So you put the two together and you're just going to get deluged with cash. A lot of our clients say to us, are we growth investors? Are we value investors? And sorry, not actual clients, our potential clients. Our actual clients know very much what we like. I always just give them Buffett's response to that, which is, look, if you say you're a value investor, you're using one word too many.
Right.
You're an investor. Growth is just attached to the hip of value.
It's a component of what you're prepared to pay.
Yeah, so we're investors, but all we're trying to do is check that the cash is there, how much cash, and compare that cash to what we're being asked to pay today. So the definition of investing is laying out money today to receive more money tomorrow. It's as simple as that.
And how do you determine what you're prepared to pay for that? How do you value it?
Everyone can do their own spreadsheets and work it out themselves, but I personally quite like sort of getting the cash back near term. We're just about to write on a company in Hong Kong, actually, for the global newsletter, where its net cash is basically the same level as its market cap. And it is definitely their cash. And we trust them with that cash. They're going to do sensible things with it. It's earning whatever, 3-4%. They've got two really great restaurant chains, and they're generating a huge amount of profit.
And the market cap of the company is the same as the net cash on the balance sheet.
Yeah.
So the operating businesses are there for free.
And they are very good operating businesses. Anyway, we're just about to write on it for our monthly stock time. In terms of valuation measures, I'm quite old school. I like a PE and I like a near-term PE, sort of historic and current year, maybe at most 1 year out. But I also very much like, and we like, enterprise values and NOPAT. So, factoring in the gearing so you can really see, the impact of companies that use a lot of debt and companies that don't use a lot of debt. But, a number of the guys use internal rate of return, a whole series of different valuation measures to try and assess whether you're getting something for a very good price. I think it's very important to bear in mind that if you have to start working out what the tax charge is going to be to justify investing in something, you must be on the wrong track. I think it needs to be knocking you over the head that it's massively mispriced. As I say, it's better to be roughly right than precisely wrong. The obvious question for me always to answer is, where is our edge? And big edge we have is the ability to think long term, which I sort of alluded to earlier on. And I think that edge is actually increasing. The more and more you get the people focused on the short term, the more and more you get the free flow of information. Everything's available online. It's there's so much focus on the next quarter's results, and the more people do that, I think the more opportunity there is to people who genuinely think and can act for the long term. But possibly the biggest single advantage we've got, which is why we hard closed so early on, and a key reason why we left Barings, is that we just think the small cap universe is amazing. It's just so nice to invest in.
I was reading your first newsletter, the 1998 newsletter that you wrote when you first launched the fund. And in there, you talked about the difficult time the small cap market had been through in the late 1990s. It sounded very familiar to the way smaller companies, particularly in the UK, but I guess across the world really, have underperformed large cap in recent years. I think it's probably been most acute in the UK, but I know that's the market I'm most familiar with. And I know you're bottom up rather than top down, but the truth of the matter is the level of institutional skill, the level of human capital that is looking at the small cap market from an institutional perspective has dwindled to very, very little in those periods. I think the same was true in the late 90s, when you launched the small cap fund. The advantage that you have, you just got to look at the published newsletters on your website, the time that you've been doing this and the breadth of coverage that you've had. And as you brightly point out, I don't know, there's 4,000 or 5,000 companies in the European small cap universe. You've only got to pick a handful every year to outperform, which sounds, it's not that easy, but even in tough markets, you can find good stocks.
Yeah. Gerhardt, he always had this saying, it's quite a cruel saying when you think about it, but it's quite funny. He said, Geoff, investing in small caps, it's just like taking candy from kids. You just walk past, grab the candy and eat it. And my saying, or the way I think about it, is you've got all these incredibly clever people who are sort of focused on large companies, doing incredibly detailed spreadsheets, getting an edge. But the more and more clever capital, human minds that get attracted to that area, it's very, very difficult to outperform. So the way I look at it is, not that I'm a fisherman at all, but if I was, it would be like, why fish where everyone else is fishing? Why not make the effort and walk and walk and walk and find someone great to fish where it's very easy? But not many people, hardly anyone really wants to do that because, obviously it's not as good economically. It's very easy to do.
Perhaps we could just talk a bit about the launch of the Global Fund.
So that was launched in 2016. It was launched very much with one of our senior PMs being sort of instrumental in wanting to launch it. It developed quite an interest on the shorting side, looking for particularly fraudulent shorts. And also, as a result of the work he did on European companies, he found himself working a lot on US businesses. So, we had a decision to make to either sort of keep him or let him go and set it on his own. And it made enormous sense all around, we thought, to set up the fund with him leading it. So that's how it came about.
And it had a very successful few years after launch as well.
Yeah, no, so it's very much focused on developed markets, investing to avoid overlap with the European fund. When it comes to the European stocks, it's definitely investing into slightly larger companies. Well, certainly not sort of the micro and small cap. So we don't tread on the toes of the European fund. Certainly, from our personal point of view, I think from Ennismore's point of view, it's a fantastic product to have long term. It's brilliant to be able to invest globally. I basically semi-retired for the best part of a decade, from 2010 till 2020. So this is now my second stint at Ennismore. I started running money again in August 22, and I took over the senior PM's portfolio on the global fund, which had substantial troubles in 2020. But I can honestly say I'm loving the freedom to invest globally and discover all sorts of very interesting companies. As I mentioned, we're focused very much on developed markets, so we're still finding a lot in Europe, say slightly larger companies, but also the States, Japan, and selectively in Asia as well. Actually, we've just made this investment in Hong Kong. We've done our first investment in the Philippines. Yeah, so it's good.
Someone looking at the track record of the global fund since launch, which was successful for a number of years, had a torrid 2020, 2021, and then has performed well since then, might look at that and say this is a bit of overreach. This is a small cap fund manager who's bitten off more than they can chew or gone into a territory they didn't fully understand. My understanding is there were some specific issues in 2020 with, obviously, we all suffered from COVID, but the US market, particularly with its meme stock craze and squeezy markets, became notoriously difficult area of the market, particularly if you're looking to short stocks.
Yes, COVID was a pretty horrendous year for us. It's the second own goal that we've scored, and it was very much the meme madness in the States that caused the troubles for us. So the fund was down 21% in 2020. The team that is here today, and all those portfolio managers were actually positive in 2020. But a key reason I did come back to the business, actually came back at the end of 2020, was because of the problems that we had in the global fund in 2020. And I think we learned a lot. One of the first things we did in detail, we sort of internally what we call the 2020 hindsight report. The bottom line is we were too stubborn and the portfolio wasn't in enough balance as the madness happened and developed. We let the positions run too much. Of course, we had controls in terms of position size, but when stocks that in the past hadn't been correlated, suddenly they became correlated. We were caught off guard. And I think, we'll put in place a number of things in terms of creating more of a team and improve risk framework that should very much ensure that sort of situation never happens again.
I think, was it Keynes who said that the markets can remain irrational longer than most people can remain solvent?
Exactly. To win the game, you have to be in the game. One of our key rules or sayings is, it's quite corny, but it's quite important to remember, is there's 2 rules of investing. Rule number 1, don't lose money. Rule number 2 is don't forget rule number 1. That really is all it is about. That return in 2020, more than that amount was purely on the short book. And I think moving forward, what's fascinating when we write about it, quite regularly in the sort of quarterly newsletters that we have in the global, is that, we think the future performance will come very much from that side, taking advantage of the madness of crowds, the excess that we see. We're pretty confident moving forward we'll be able to benefit from that as well.
I guess the difference in the experience that you described in 2008-9, when things were going down, compared with 2020, when everything was going up and everything was correlated, it was the everything bubble, the everything rally, the world was pumped with liquidity, is that it's managing risk on the short side is that much more difficult and delicate than managing risk on the downside, all other things being equal, because there's infinite upside, there's known downside. Day in, day out, if you get it wrong, it becomes a bigger problem. Whereas when you're long something that's going down, each day it becomes a smaller problem. That must be a very difficult thing to get your head round. Yeah,
there's always different reasons on it for the madness, but I think particularly in the States with the meme crowds and AI euphoria, it is a tricky time. So you've got to duck and dodge very carefully and don't be too stubborn. Don't just rely on all the fundamental work. So have respect for Mr. Market, your partner who's coming in to offer you prices every day. That's really, really important. I mean, of course, the poor chap is sometimes incredibly euphoric, sometimes incredibly depressed, and he's going to offer you all sorts of interesting prices based on the fundamentals. And so it's your job to take advantage of him, but not to be guided by him too much or to sort of believe in him too much. But nevertheless, very, very key, crucial, is to have respect for him. And, occasionally he's going to be right. So he might be right in the short term, and the short term could be for a few years.
For longer than it makes you comfortable, yeah.
Exactly. So therefore, how do you deal with that on the short side? I think the weightings are very important to, weight accordingly. Don't have too large weightings. Yeah, and just constantly monitor the nature of the portfolio of the short book, how it all comes together and how it's behaving. And remembering, as I say, the two rules of investment. It's really, really good to have that shorting ability. I would say we are regularly improving our shorting expertise. We've just recruited a senior guy from the States who's Canadian, who joined us last September, and he's got a lot of experience. So he's quite an unusual situation for us. We don't normally give people money to run very quickly, but we've given them a sensible amount to run on the global fund. And yeah, he just loves the shorting side, and is a real expert in it. So I think the team we have, another example would be one of our guys who joined in 2007, who's, again, just absolutely loves the shorting side. And we have a lot of expertise in that area. And I think overall, there are many, many massively mispriced, overvalued situations. The long short spread that we have, which I talked about earlier, that is key. Obviously, that was tough in 2020, but since then it's come back to the long-term trend of roughly 20%, even slightly more per year. In terms of risk, that quality of returns, I think that's a pretty important measure. And the fact the returns we've generated have been generated without taking any gearing. We're not a typical hedge fund in that we don't use the balance sheet much.
You don't juice the returns from leverage.
Yeah, not at all.
So how do you sustain it? You set the business up, you sort of got it going, great long-term track record of the original fund, unbelievable track record of the original fund. You've come back in to take a more frontline role, mainly on the global fund, but across the business. You're bringing new fund managers in, and you've got growth now to scale up a bit, particularly on the global fund. How does this business sustain itself? How do you bring in new talent? Can you talk a little bit about that and what the future looks like?
Absolutely key for me is the idea that Ennismore is here, not just for the next 25 years, but is here for many, many years after that. I want people who stewards of the business, I suppose, who will look after it. And I think one of the keys to longevity is developing talent in-house. But, the starting point is obviously having the right approach to investment. And that really can be summarized by saying what we want to do and have done, definitely will do in the future, is to have a margin of safety investment house, and people who think properly about investing and are there for the long term, think long term, like the sort of the transparent, the meritocratic remuneration system, also like sort of the clawback angle, which creates a fairness situation. They like the sort of risk averse nature of, never reducing returns, always exploiting major mispricings on the long side and the short side by taking advantage of Mr. Market and by focusing on areas where others don't focus. And occasionally, of course, we will have sort of like a real information edge. We're just as a result of the quality of the work we do by checking things out independently. So I think that's key, to always have that sort of margin of safety umbrella and have a sort of a group of people who are the stewards of that. And the development of talent in-house, that's something new that we've started since I came back in at the end of 2020. We've started what we've grandly called the Ennismore Academy. We have 4 graduates who are already doing some pretty impressive work for us. I think the great thing about getting people in reasonably young is that it very much gives you a chance to stop them learning what we would consider to be bad habits. We spend a lot of time, both in terms of the recruitment process, to make sure we get very good people, but then once they've joined us, make sure they get the right training. So we have a rotational mentor-mentee arrangement with each of them. Obviously, they're doing the CFA. They're working very well. In fact, we're already at the stage where 2 of them, we're going to give a small amount of money to run, one in the global fund, one in the European fund towards the end of the year. It'll be tiny, but it'd be a way for them to really put their ideas into action. And that's, again, has always been our way. Something what I did with the guys sort of 20 odd years ago. And I think makes a lot of sense, rather than have a situation where the analysts are always saying, oh, if I'd been allowed to, you didn't invest in this one, you didn't invest in this, so give them a chance to actually put the money where their mouth is. Yeah, so the future of Ennismore for me is very much to never, ever give in to sort of just taking in assets for the sake of assets, for the sake of generating revenues, just complete focus on performance and stick to our knitting. And I see my job is to make sure that happens. But the future will be very much about the sort of the fourth generations of people coming through. That's what we're already on. We're very lucky because we offer people a chance of running money at an early stage. We're a very attractive place for possibly quite a senior analyst at a hedge fund who realizes they're never ever going to have a chance to run money because of the classic structure. One of our guys, Rich Stuckey, he was at Delphi in exactly that situation. So he joined us 2017 so that he could run money, and he's doing excellently. And I think with the chap I mentioned, who's joined us from the States, Sashan Sakra, same situation. He was number 2 for a large hedge fund, but realised he would never run money. So he's moved his whole family over to London to join us. In many ways, we're punching above our weight, above what you would expect to be our weight, because that global fund is only 140 million sterling. So you wouldn't necessarily expect us to be able to recruit, from the outside looking in, that type of calibre of person.
The European fund has been capped for most of its existence. How big can the global fund be?
At the start of 2020, I think it was 500 million. So
okay. But you were only getting going then, really, weren't you? It could be a lot bigger than that, surely.
We'll see, because it's global, because it invests in still small cap and mid cap, but companies which are larger than the European fund. It could easily be 1 or 2 billion without impacting on its performance. The European fund as well, to be honest, we haven't replaced the odd redemptions that we had over the last sort of 10 years or so. So we reckon there's about 40 million of capacity in the European fund, 40 million sterling. But then that will hard close again. Whereas the global, if we take in some money, we'd close, but we'd close most probably for a period of time, and then we would give priority to existing investors if or when we reopened it. So the global fund can definitely be quite materially bigger than it was actually.
And how many fund managers would you expect to be running the 2 funds at capacity, or is that not the way you look at it?
3 to 5, certainly in the past, was the number that I found worked very well. Larger than that, it became more tricky in terms of man management. And I think that definitely works for the European fund. By the way, I'm the only PM that manages money in both strategies. And the thinking there is just to keep an eye naturally on both. Other than that, it's distinct teams. So there's 3 distinct PMs on the European fund, and we've got a 4th joined as an analyst initially in September. So that'll be a team of, include me, 5, and then one of the grads to make it 6. So that will be pretty much a full team. And then on the global team, we're looking for 1 more person. But clearly as that, because of the global nature, that could be, I guess, over a long period of time, because there's such a wide geographic scope, that could easily be 10 PMs. But again, we're not going to rush to get there.
Thanks so much for your time. It's been a great chat. You've done a brilliant job. I think you've been very open and transparent about what you've learned along the way and the way that you shaped the business through some tricky times with some brilliant performance. So hopefully we can have a chat again at some stage and maybe chat in more detail about particular stocks and how the team develops. Thank you.
Thanks a lot, Jess.